The ships were already loaded, contracts signed, and the pork was on its way. Then suddenly, bam! 12,000 metric tons canceled overnight. No warning, no explanation. Just a quiet market update buried among the usual news. China cancels a U.S. pork shipment. The timing was perfect, and the consequences could be huge. But why now? Why this shipment? And why such silence? This wasn't a delay caused by bad weather or shipping problems. It was a sharp, deliberate cut. Remember, this pork was already bought, processed, packed, chilled, and paid for. So the big question is, what did China know that no one else did? Stick with me, because this isn't just about pork. It might be the first warning shot of a new kind of conflict. At 2:42 a.m. Beijing time on April 18th, a quiet order went out to Chinese importers. Cancel the U.S. pork shipment. All 12,000 metric tons already en route weren't delayed or rerouted. They were canceled outright. Major sources like Bloomberg and Reuters confirmed the directive. Port operations in Ningbo and Dalian, where the cargo was set to arrive, were instantly suspended. No official reason was given, but this wasn't business as usual. It was intentional. According to Chinese customs records, this was the largest mid-shipment port cancellation in over 5 years, valued at about $35.4 million based on April's average price of $2,950 per ton. The mystery remains, why cancel something that's already paid for and halfway there? This wasn't a random move, it was strategic. Just 3 weeks earlier, on March 25th, the Trump administration imposed a 172% countervailing duty on all Chinese pork imports, citing USDA investigations into illegal subsidies and veterinary violations. Beijing didn't retaliate with its own tariffs or fiery statements. Instead, it stayed quiet, then made this precise surgical cancellation. Chinese Foreign Ministry spokesperson Lin Yan denied any direct link between the U.S. tariffs and the cancellation. But internal documents, seen by the South China Morning Post, suggest this was a calculated retaliatory move, a textbook example of precision decoupling. This wasn't really about pork.
It was a message, says Dr. Hao Wu, trade analyst at Fudan University. Even long-standing commodities aren't off limits anymore.
And if this was only symbolic, why were pork buyers in Brazil and Spain celebrating by morning? This wasn't just a headline, it shook the market. The National Pork Producers Council reported that this cancellation caused a sudden backlog of 26 million pounds of pork, roughly 110,000 hogs, redirected to domestic markets already struggling with seasonal oversupply. States like Iowa, North Carolina, and Minnesota, which together export about 60% of U.S. pork to China, were hit hardest. In Iowa alone, the Farm Bureau estimated direct losses at $9.7 million. But the ripple effects, falling auction prices, overwhelmed processing plants, and job cuts could push losses to 3 times that within 48 hours. For example, a pork processor in Worth County laid off 117 workers.
This isn't just a disruption, it's a vacuum, said Chris Novak, CEO of the NPPC.
And into that vacuum, new suppliers rushed in fast. By April 19th, the day the news broke, Tyson Foods shares dropped 4.3%, and Hormel Foods fell 3.1%. Analysts were divided on what this meant. A memo from Citi Research called it a one-off retaliatory move. But Morgan Stanley strongly disagreed, saying it marked the start of a major shift in how China sources its protein. Recent data reveals a deeper issue. Markets are still viewing agricultural exports through the lens of short-term price swings, ignoring the long-term geopolitical risks. And that's a big mistake. Take the CME Lean Hog Futures Index. It fell 6.5% in just 72 hours, the steepest weekly drop since the 2020 supply chain crisis.
Right now, markets are treating this like an isolated incident, says Chen Junpan, global protein strategist at Rainbow Bank. But China is signaling something much more permanent.
So, where is this new direction headed? While U.S. pork stays stuck in cold storage, Brazil and Spain have jumped at the chance. Brazil's Ministry of Agriculture reported a 28% increase in pork exports to China in April alone. Sao Paulo-based BRFSA stepped in to fill emergency orders that would usually go to U.S. companies. Meanwhile, Spain's Pork Export Council, Interpork, confirmed a 23% year-over-year rise in Chinese demand. New fast-track customs agreements were signed in Shanghai just days after U.S. shipments were canceled. Brazil and Spain now make up 48% of China's pork imports, up from previous levels, while the U.S. share dropped to 19% from 33% last year, according to China's General Administration of Customs.
This isn't diversification, says Alicia Garcia Herrera, chief economist for Asia Pacific at Natixis. It's replacement. The U.S. isn't just being outbid, it's being strategically sidelined.
Here's the big question. If China keeps canceling shipments, do we adjust or break down? Drop your thoughts in the comments because what comes next is something few want to admit. There is no official ban. Since mid-March, several U.S. companies that export pork have reported unexplained delays at Chinese ports. Internal USDA documents obtained by Bloomberg show that Smithfield Foods had 2 shipments held up because of long inspections. JBS USA also said China stopped answering questions about several ongoing contracts. Behind the scenes, Beijing updated its import rules, now requiring full transparency on where the supplies come from, and stricter biosafety standards. Some U.S. facilities don't meet these new rules. What does this mean? China is quietly filtering out U.S. exporters without openly breaking World Trade Organization rules.
From a legal viewpoint, Daniel Portman, a trade lawyer experienced in U.S.-China disputes since 2018, calls this a de facto blacklist, disguised as technical regulations.
If this trend continues, it could go beyond a short-term tactic and lead to a slow economic breakup, industry by industry. The economic fallout didn't stop at lost exports. It triggered a chain reaction hitting America's farming heartland hard. By April 22nd, official U.S. Department of Agriculture data showed pork stored in cold storage reached 634 million pounds, a 14% rise from the previous year. That much pork sitting unsold is a warning sign. Demand is dropping, but production hasn't slowed. Wholesale prices for pork bellies and loins fell 17% in just 8 trading sessions, a huge drop in a short time. Retailers like Kroger and Costco had to offer big discounts to move products, but even those weren't enough to handle the oversupply. This isn't just about prices or discounts. It's a supply and demand mismatch. American families can only eat so much pork. Without exports to take the excess, the system starts breaking down. A recent Wells Fargo report on agriculture gave a clear warning. If exports stay low, farm profit margins could shrink by over 22% in one quarter. That's not a gentle decline. It's a collapse for producers already stretched thin. Small and mid-sized farms are especially at risk. Many have struggled for months with rising feed costs, higher energy bills, and tighter loans. In Missouri alone, 6 independent hog farms filed for bankruptcy in April because they had too much pork they couldn't sell, and prices too low to stay open. If this pattern keeps up, the real failure won't show in supermarkets but at the very start of the supply chain, on the farms. And when those farms close, the long-term damage will be much worse than we realize. But pork might only be the beginning. In January, China quietly approved a new 5-year food security plan. Deep in the plan is a strong goal: reduce dependence on food imports from unstable political sources by 40% by 2028. The U.S. isn't named, but analysts from ING and Rabobank say the message is clear. Since 2023, China has moved carefully but firmly, investing billions in agricultural technology, boosting local food production, and building over 80 million cubic meters of new grain storage. These aren't defensive moves, they're proactive. At the same time, China signed long-term pork and beef supply deals with Brazil, Spain, and Argentina, countries Beijing sees as more reliable. Meanwhile, U.S. soybean imports to China dropped 25% in the first quarter of 2025. Brazil and Paraguay made up the difference. This isn't a quick reaction. It's a methodical, strategic approach.
China treats food security like the U.S. treats semiconductors, says Darren Friedrich, founder of Satonia Consulting.
The goal is to build long-term resilience, making sure no single foreign supplier, especially not the U.S., can disrupt their food system. If pork is a high-value strategic product, the next moves could cut even deeper. In 2024, China imported $15.6 billion in soybeans, $5.1 billion in corn, and $2.2 billion in beef from the U.S. These agricultural goods were the second largest U.S. export to China after semiconductors. But first quarter 2025 data paints a darker picture. Soybean imports fell 26%, corn exports dropped 33%, and beef imports were cut in half. At the same time, imports from Brazil and Argentina jumped by double digits. These aren't random changes. Bloomberg reports that COFCO, China's state-owned agricultural giant, is quietly moving away from U.S. grain suppliers, not with loud announcements but through non-renewal of contracts and shifting orders to other partners. In April, China signed a major 20-year food security deal with Russia. It includes special import terms for staples like barley, wheat, and beef. This deal is about locking in a stable, long-term food supply that excludes the U.S. Putting it all together, this is more than a missed shipment. It's a quiet, calculated economic decoupling happening commodity by commodity. So what if pork, soybeans, corn, and beef all disappear from China's U.S. order lists? It's not just lost money, it's lost influence. And that's a much bigger risk. When 12,000 metric tons of pork get canceled mid-shipment, it's not just a shipping problem, it's a message. Not just to farmers, but to every American industry relying on China's market. Ask yourself, if China can carefully cut pork imports, what else could they phase out with the same precision? Semiconductors? Pharmaceuticals? U.S. government debt? The next cancellation might not show up on a bill of lading but could appear as falling bond prices, a Wall Street sell-off, or supply chains grinding to a halt. Before you scroll on, think, what if real decoupling doesn't come with headlines or speeches? What if it happens quietly, one cancellation at a time? If that's true, then China's biggest move hasn't even started yet.